Welcome to Sectors Up Close. I'm Elena Casas. Today we're talking mega-cap tech stocks with Keith Gangl, portfolio manager at Gradient Investments. Huge rallies in the so-called Magnificent Seven stocks have driven nearly all of the S&P 500's year-to-date gains because of their outsized weightings on the index. That means their performance has raised the stakes in the upcoming earnings season, with an average forward price-to-earnings ratio at 33.5 compared with 18 for the wider market. All this while the relentless rise in Treasury yields makes for good competition for stocks, especially if they're unable to deliver strong results. So far, only Tesla has reported, disappointing the market and prompting CEO Elon Musk to sound the alarm on the impact of higher interest rates on car buyers. So, how should investors position themselves? Let's ask Keith Gangl at Gradient Investments, who owns all of those stocks except for Tesla. Keith, hi, thanks for joining us. Why not Tesla? Why don't you think it's a good buy at the moment?
Well, the reason we haven't owned it in the past has been purely on valuation. We like the story, great CEO, but the stock's been up over 100%. And so we're a little bit nervous, especially in this quarter, what the stock would do. They actually came in and reported a little bit disappointing. They've been discounting their cars, so their margins are getting a little bit worse. And that's one thing we were fearful, and that's actually starting to happen a little bit. Elon Musk also called out the macro factors. Higher interest rates going to reduce affordability. So again, their cars are not cheap, so that's going to impact them as well. And the other thing that people are excited about is the Cybertruck. Now that rollout is going to be, you mentioned on the call, is going to be a little slower than people anticipated. So again, these are some of the reasons that we haven't owned it, but we'd like to own it. And if the stock came down to a little bit more reasonable valuation, it's certainly a name we'd like to get involved in.
10-year Treasury yields, Keith, have recently hit 5% briefly. With yields at that rate, isn't it going to take some of the shine out of mega-cap tech stocks?
I think it could potentially take the shine off of the market in general, but I think less so for mega cap technology. The reason that high interest rates take a shine off the market is it makes valuation a little bit more stretched. So valuations historically have come down on the overall market. They have great growth rates. They're cheap. They're cheap relative to the growth rates as well. They have fortress balance sheets. They have sticky products, and again, they have great free cash flow. Where some other companies, you take the housing industry for example. The housing rates here in the U.S. are about 8% on a 30-year mortgage. That's certainly going to slow things down as well. So anything housing related is going to slow down. But these consumer related big tech names that we own, we don't think so. At least they're going to be the last ones to get hit, we believe.
You mentioned in a note, Keith, that you've actually sold off some of these holdings recently. Is that an indication they might have peaked?
No, not necessarily. We still own most of these names. The reason we sold them down a little bit is just because they've had a great run this year. They're up 50, 60, 70%. Or plus per year, so we like to take a little bit of profits, and we do think that they're on the valuation. Like I said, we believe they're very reasonable, but some of them are getting a little bit stretched. Apple's a prime example of that. That was trading at about 30 times. Now it's come down here a little bit. It's trading at about 27 times. We still own it. We trimmed it. We'd like to add it back some, but we'd like to add it back when the multiple is maybe in the mid to lower 20s and the growth rate starting to accelerate.
Microsoft, Keith, is the next one of these names to report on Tuesday. What are you expecting? Is it going to retain some of its lead that it has in AI after rolling out ChatGPT?
We do it. Microsoft's another name we do like, again, but that one I'd say is kind of middle of the pack on the valuation. That's trading at about 24 times for high teens growth rate. The reason people got so excited about it this year is obviously the AI driver, ChatGPT. They're going to be a leader in the space. So if anybody's going to capitalize on it, it's certainly going to be Microsoft. So it's a name we want to stay involved with. But again, it's getting a little bit on the higher end of valuation. We still like it. We still want to own it. We expect good things out of this quarter. And again, this is the kind of companies that's accelerating earnings, increasing margins. Those are the kind of companies we want to own.
What about chip makers in the AI future? Nvidia has, of course, gained pace to join the mega caps this year. What's next for it?
Yeah, we like Nvidia a lot. Obviously, last year Nvidia was pretty expensive, but they had phenomenal growth rate with over doubling of their revenue and EPS. So their 60 times multiple people didn't want to pay on their PE. Now that's down to 24 times. 24 times for a company that's growing 60% next year. Now we think that might be a little bit overstated after their 100% growth this year. So you have to dial that back a little bit again. But 24 times multiple, we think Nvidia is a name to own. It's a good they are the player in AI as well. So if you want to invest in AI, this is a way to play it. But again, that stock's had a nice run this year as well, so we wouldn't be surprised if it has a little bit of pullback here. So they have to have a really good quarter and good guidance, but the last two have been phenomenal. Those quarters beat by several $billions, which is something that's unheard of. We haven't seen that since Apple's early days when iPhones first came out.
Keith Gangl, Portfolio Manager at Gradient Investments. Thanks so much for joining us. And that's your roundup of the mega cap tech stocks. I'm Elena Casas, and this is Reuters.